right, today is Thursday, October 9th, and this is a post-market review for the activities today. Here is the agenda of the day. Per usual, and of course we will discuss the whole stimulus fiasco back and forth. I have all the information that you need. We also have interesting information in the rotation trade, and we will cover charts of the SPY, the Qs, dollar index, the VIX. And are you ready for this? TNX, the 10-year yield. It's been moving significantly this week, so we'll take a look at it, and we'll do Tesla, of course. And here is the newcomer for the charts analysis, GM. And here we go, the diamonds in the green, about 122 points, or a gain in the futures. We'll cover that, don't worry. But it is a gain of 0.43%. And the Nasdaq in the green, 56.38 points, or a gain of 0.50%, half a percent right there. S&P 500 in the green, 27.38 points, or a gain of 0.80%. S&P 500 led the day because we have the weaker sectors leading the rally today. And speaking of that, let's check on the sector's performance. The gold medal goes to energy. Can you imagine that? How long will the energy rally last? The silver for real estate, and the bronze goes to utilities. Very defensive theme today. Every sector closed in the green, so we don't need to shame any lagging sectors. Moving on to the futures performance. Crude oil, big gain today, and it looks like, at least in the short term, crude oil did a double bottom and it is ready for a mini rally. Of course, remember the correlation between oil and the dollar index. One of these two names would rally, the other won't. So if the dollar index has another trick up its sleeve and it will explode higher again, you bet that oil prices would decline again. So it's very interesting to watch because it will have implications in the overall stock market. Other gainers in the day for the futures: OJ, coffee, lumber, lean hogs. Lean hogs is a new tech. No stopping sign here. Metals muted, so did the dollar index. It was muted, and you see that correlation between metals and the dollar. What about wheat? Wheat lagging the day, taking a break. We talked about wheat yesterday, the amazing gain in wheat, and perhaps we jinxed the rally just a little bit. Moving on to the casino, and you guessed it, number one, the hottest stable in the world. Apple, 1.25 million contracts traded today, or about 75% of those were calls. Here is the important thing to note. 1.25 million contracts is equivalent in a notional value of 125 million shares of Apple stock, because each contract has 100 options. Each option is tied to one share of the stock. Please do the homework and check out the volume traded in Apple stock today. Is it over 125 million or is it under 125 million? And you will see that the volume in derivatives is exceeding the volume in the underlying stock itself. This is the mania, the gambling that goes on every day. Apple stock is tainted and it is no longer a safe investment anymore. It is a casino. Thanks, of course, to the geniuses of Tim Cook and company, because all that we're gonna do right now after the stock split is they're going to dump shares. The executives, get richer in the process, and who cares about the future of the company itself? Apple. The stock becomes a casino. The company lacks any innovation anymore. Who cares? As long as the executives get richer. Continuing in the options market, Tesla at number 2 with 740,000 contracts traded today. 64% of those were calls. And at number 3, AMD, 600,000 contracts today. 82% of those are calls. Here are the volume leaders. Per usual, Apple, the 115 strike call expiring tomorrow. They're just rounding up to the next number, shooting a dart in the dark and see where it lands. And of course, you see Tesla, the 450, they're becoming more arrogant now that stocks are just going to explode 5% every day. Moving on to the change in open interest, and you can see the decrease in open interest. We talked about AT&T yesterday, the 28 call expiring next week. Well, they closed it today. It was just a pump and dump. They did it yesterday. Today in the morning, they dumped. It's over and done. The increase in open interest, of course, Citibank, they're buying the $40 put expiring 2022. So a little bit longer here, and it could be interpreted in two ways. Number one, and this is a very dark, is that by 2022, Citibank will be trading under $40, or of course, they're assuming the 40 will be the bottom and they're raising cash from the trade. But it is notable and it is indicative of the entire financial industry. Speaking of, let's move on to the heat map analysis. Right away in the technology sector, you see that old school tech outperformed today. Names like SAP, Cisco, Intel, and IBM. Some of these names, by the way, were the hottest names back in 1999, and now they're considered matured, old, boring companies. What's going on in communication services? You see Google and Facebook catching a bit today. Of course, they were lagging yesterday. Today, they caught a bit. These two names specifically are under scrutiny from the government, so they will trade hand in hand, at least in the short term. Moving on to financials. Financials catching a bit due to the increase in the 10-year yield, which we will cover in the charts analysis. But perhaps when we do so, you'll understand that the run in financials is probably coming to an end. But needless to say, of course, we pointed out a few weeks ago that I am bullish on Goldman Sachs and Morgan Stanley due to the trading activities. The surge in gambling in the stock market and the options market will be very good for these two names. What about healthcare? You see Eli Lilly outperforming today. They have an announcement of a certain drug that happened to overstep a drug from Amgen, and you see Amgen declining severely today. Moving on to consumer defensives, the action in beer is very interesting. We've seen beer stocks rallying about 3 days in a row now. Industrials, a sea of green. Exception here, railroads. You saw railroads outperforming yesterday. Today it was profit-taking day. No stimulus. Perhaps that's what it is. What about energy? You see ExxonMobil becoming a high beta stock now, outperforming CVX, aka Chevron, and overtaking Chevron as the highest valued energy company in the United States. Yesterday we heard the news that Chevron overtook Exxon as the largest energy company in the US. Perhaps that was a sign of a bottom here, and Exxon is getting punished severely. And you saw, of course, the name rallying today. Of course, the speculation of whether Exxon is going to cut dividends or not remain on the table. It has huge implications because assume Exxon announces cutting the dividend. That could be interpreted two ways. Number one, that the company is under financial chokehold and it is tapping out. But number two, it could be positive for the stock, showing that Exxon is serious about handling costs and restructuring its strategy. Perhaps doing what every other company is doing, cutting dividends and doing shares buybacks instead. And that, of course, will have implications across the energy sector. You will see Chevron cutting dividends as well. I'm not a huge proponent of shares buybacks because it is a tool of artificial inflation of the stock to reward executives who hit the sell button and get richer in the process. I appreciate dividend paying companies. What about consumer cyclicals? The big kahuna Amazon underperforming today, yet the entire sector had a pretty good day. But you don't see consumer cyclicals in the top 3 performers of the day because the huge weighting of Amazon. Amazon needs to be moved somewhere else because its weighting is too big for consumer cyclicals. But you see names like GM, restaurants, the residential construction names, hotels, casinos like MGM, specialty retail, all outperforming today. Massive gains. And to add more color to that, let's move on to the rotation trade analysis. Right away, you see the gains and the outperformance of the reopening stocks over the stay-at-home/momentum stocks. And tomorrow, when I show you the weekly gains, assuming we don't have a big crash tomorrow, of course, you will be amazed of the gains that certain names like Ulta Beauty, General Motors, Budweiser, Coca-Cola, you will be amazed with the weekly gains these names had, silently not attracting any attention whatsoever. Moving on to the headlines that shaped the day. Right away, we had a VP debate yesterday, and everybody was talking about the fly that landed on Pence's head, but really the implications here in the stock market and the economy, and for that matter the election, is pretty much none. We know Pence outperformed, perhaps if Trump shut the hell up and let Pence do all the talking, maybe he'll have a shot at reviving his re-election campaign. But as we stand right now, I think that the majority of voters already made up their minds, and whatever happens in the next few days will have little to no impact at all. Needless to say, it was the most watched VP debate in a long time. And here is the next piece of news. In the morning, we had the weekly unemployment claims exceeding 800,000 yet again. So all the talk about a V-shaped recovery and the propaganda that you hear from the administration and from the financial news media is not translating so well in the employment market. I've been watching financial news today on television, and you see analyst after analyst and a wealth fund manager after another wealth fund manager talking about the improving economy. And it is justified for stocks to rally, even on bad news, because the ISM numbers are great, and the housing data is great, and auto sales are great, and consumer spending and confidence is great. All the bullshit indicators that has no relation whatsoever to the real economy. And in this channel, we've exposed that when they said that the consumer confidence is rising in the fastest pace since 2003. And when we broke it down, it turns out that people who make over $150,000 a year are getting very confident. People who make under $150,000 a year, not so confident. And that happens with every ISM data that they release, assuming that they're not cooked, by the way, is they show you the overall number out of context and they don't go into details highlighting struggling industries. Furthermore, the housing bubble is happening due to 2 reasons. Number one, the rich, and there are 2 entities of the rich, individuals and corporations. Of course, the rich can create a corporation in the Cayman Island, a shell company that in times like this scoop up a bunch of properties to hide their taxes and use it as an investment. Furthermore, dumb money. The morons who are stampeding into buying houses right now due to low mortgage rates. Well, there are 2 components to that. The price of the house, which is going up, and the mortgage rate. What is the point of paying a lower, slightly lower mortgage rate if the price of the underlying house went up severely? Don't expect any intelligence there. Likewise in auto sales, we gave people a little bit of stimulus. We saw some favorable deals from auto dealers. Right away, they stampeded on leasing and financing new cars. Dumb money. And now when dumb money makes huge purchases such as housing and cars, they've already exhausted their spending power. Add to that the increase of permanent unemployment and unemployment claims, and now you see that the surge that we had in the beginning of the coronavirus crisis, the surge of consumption, is going to start to collapse due to the drainage of savings and reserves in consumer spending. Don't expect to hear this perspective anywhere in CNBC, Bloomberg, any of them. Now, let's cover the whole stimulus fiasco. We knew right away after the market dropped due to Trump's tweet that he's canceling the stimulus talks, the Dow Jones Industrial Average reversed and traded lower 600 points. And of course, that spooked President Trump because he is fixated and addicted to watching the stock market tick by tick. He has this belief that if he goes into re-election with the highest stock market ever, that would guarantee his re-election. What he doesn't know is most Americans could give a rat's ass about the stock market. They're not invested in it. And I think this is his Achilles heels. Remember the interview Trump did with Bob Woodward that got exposed recently. And he said that he did not want to create a panic by being serious about containing the coronavirus. He didn't want to panic us. The reality is he didn't want to panic the Dow Jones, and his fixation on the stock market made him commit serious mistakes, and folding 7 hours after canceling stimulus talks is another error. And when we look back in history, you realize that the fixation on the stock market is what brought the demise of this president. Moving on. We've heard, of course, right away as we started the trading day, Pelosi Nancy announced that she's not interested in a carve-out deal for airlines. She's either going to do a wholesome deal or no deal. And you saw airline stocks, of course, giving up lots of the gains in the morning. And as expected, of course, the Robin Hoodiots and the gamblers in the options market, instead of running away, they dive Naruto style, heads first, right in the way of danger. They went on and they bought airlines calls, assuming that Nancy's bluffing. This is the mentality dominating the market right now. Gambling, arrogance, recklessness. You think this is going to end well? Think again. And here we go, more details on the whole fiasco of the stimulus. After Nancy said that Mnuchin didn't call her, we now know that they finally had a call that lasted about 40 minutes and was pretty much fruitless, and in it, we understand that there was a confusion on who is in charge. Is it the White House communication director, or is it Mnuchin, or is it the president? Who is it? And Nancy now assuming that Mnuchin speaks for the president. We know that Mnuchin was surprised just like anyone else by the president's decision to end the talks. So Mnuchin's pretty much a busboy right now, communicating on behalf of the president. He has zero power. Continuing, we've also heard from the GOP leader Mitch McConnell, who said that he thinks that the government did enough aid, aka not interested in new stimulus. Very important statement, yet the market couldn't care less, continued to rally throughout the day. And we do have two GOP senators who are now saying no to a carve-out airlines deal because airlines already have ample liquidity. And if we're going to single out airlines, what about hotels? What about restaurants? What about the other industries? And of course, if you look deep into these two GOP senators, you'll figure out somewhere that the hotel and restaurant industry is among their donors list. And they told them, hey, if you guys gonna favor airlines, what about us? And by the end of the day, perhaps the most optimistic take that we will have a stimulus deal very soon. We have a tweet from the president calling Nancy crazy Nancy, and then of course due to her invoking the 25th Amendment to remove the president. So it sounds like a love fest right there. They're ready to make a stimulus deal. And we do have news from the Fed, specifically the Dallas Fed Kaplan. And this is important because we're talking about whether we need a stimulus or not. Here is Kaplan saying that when it's all done, the US economy will experience only a drop of 2.5% in growth. That is it. We know that the Fed is a very confused organization. Here is Kaplan in May urging the government that we need more stimulus, we need more fiscal help. And then in September saying that unemployment benefits extension is critical. Yet he also said that we don't need more monetary help from the Fed if the economy is recovering. So on one hand, he's saying the Fed is tapped out. On the other hand, he's saying, hey, it is on the lap of the government to do some fiscal spending. But with the same mouth, he's saying that the drop in economic growth is just 2.5% and the Fed doesn't need to do anything more. So does that mean that the government doesn't need to do more? Is Kaplan walking back his previous statements? Who knows? It is a very confused organization. And we do have a warning from PIMCO saying that returns in the stock market would drop while volatility will increase for the next 5 years. I talked about this a little bit yesterday during the rotation trade analysis. I told you that easier market in the 20 teens will be followed by harder markets in the 2020s, and the heyday of buying technology names and witnessing enormous gains, that is over. And now you have to pick boring names and tamper your expectations of growth. This is exactly what PIMCO is saying. They're saying that the bad news and the bad environment for the macro economy will catch up to risk markets sooner or later. And let's end this segment with some positive and happy news. The wealth of the richest 50 Americans is now equivalent to the wealth of 50% of all Americans. So 50 guys in this country have more wealth than about 175 million Americans. The top 50 people have more wealth than 175 million Americans. No biggie. It sounds just like the economic system that we have is functioning perfectly. And now moving on to the charts analysis, right away starting with the SPY at 15 minutes chart. We talked about two important levels yesterday, the top of the breakdown candle and the level of 342.40 as the next resistance levels. Right away in the morning we gapped above the breakdown candle and above the 342.40 level, taking two resistance levels in one move. But notice how that the level of 342.40 acted as perfect support today. The SPY checked and rechecked the support level and decided to take off as the day progressed. Again, it is not a coincidence how we pick these support and resistance levels. What do we see from a daily perspective? Nothing new. You see the reverse head and shoulder formation taking place and the SPY looking bullish right now. Moving on to the Qs, 15 minutes perspective. We talked about the breakdown candle as the next level to catch, and we also talked about the resistance level of 281.60. Now, from a 15 minutes perspective, since we did gap up above these levels, you see that the chart of the Q went down to the breakdown candle, the upper limit, and that became support for the chart. Likewise, the 281.60 became resistance. It flipped back and forth between support and resistance throughout the day, but it ended the day being resistance, holding its feet, meaning the Qs finished the day more bearish when you compare it to the finish of the SPY. Let me show you from a 3 minutes perspective. The 281.60 level, there you go, being very accurate level of resistance. Once we broke above it, acts as support, but when we dip below, it acts as resistance. Now, what do we see from a daily perspective? Nothing new. The reverse head and shoulder formation playing out. Moving on to the VIX. Remember, we did have the stick sandwich formation yesterday, which is supposed to be bullish. Yet the ice cream sandwich melted under stimulus optimism. And you saw the VIX trading lower today. However, the good news here is the 24.8 support held yet again, signaling that the VIX is not ready to drop yet. Moving on to the chart of the TNX, which tracks the 10 years treasury yield. And we're doing a line chart comparison here with the yellow line as the TNX and the blue and orange lines for the SPY and the triple Qs. Right away, you see every time the TNX topped out, it was a reliable signal for a reversal in the indices. It acted as a leading indicator, and the action today looks like a potential reversal and a sell signal for equities. If you see yields declining tomorrow and the dollar index rising, that would be a good signal that we are topping off in the market. And speaking of the Dixie, let's talk about the dollar index, 15 minutes perspective. We talked about the level of support of 93.50. Today, we paid a visit for 93.50. I didn't expect it to happen this quick, but it did, and the level held and bounced from it. So for now, the dollar remains intact, but the longer it lingers around and refuses to move higher, it would signal that perhaps the dollar is exhausted and the dollar shorts are not ready to cover, will not cover. However, this is a very fluid situation because the flow of news. If we do have negative news happening, you will see panic short covering in the dollar, and the dollar will explode higher, having implications on the indices, oil, gold, copper. So there is a reason why they call it King Dollar. Moving on to the chart of Tesla. 15 minutes chart, you see that the gap at 425.36 held for now, perhaps because we ran out of time. We will see if it continues to hold yesterday, or tomorrow rather. And when we take a look from a daily perspective, we see a series of lower highs and higher lows. If we do reverse and break the trend by making a lower low, that would be a very reliable, solid signal that Tesla is a stone cold short. Of course, I'm not going to wait till that happens. I'm already positioned via options to reduce my risk by buying November puts on Tesla. Now let's move to another auto manufacturer, General Motors. Here is a daily chart of GM, no markings or comments by me. And here is the chart with my drawings. You see we do have a trend line that is acting as very solid support, a rising wedge. And we do have a reliable level of resistance at 32.88. And my projection is perhaps GM will go back and forth between the support and resistance before breaking to the upside. I am a shareholder of GM and I continue to add to my position, and I am bullish on the name. And now let's conclude this video. The stimulus fiasco goes on. However, I am worried and cautious because I've seen this movie before. When the market becomes so arrogant, climbing the wall of worry, buying calls on the airlines even after we found out that there will not be a carve-out deal for the airlines, shorting the VIX day after day, shorting the dollar significantly, even as far as shorting gold. These are all signals for the arrogance and the euphoric sentiment in the market. If there are any bad news, no problem. We will search throughout the rubble and find some thread of hope and positive news to twist the tragedy into and rally the market based upon. We have seen this happens, of course, before the big correction in 2018 in February, and we've seen it, of course, before the coronavirus crash. We heard about all the bad news in China and even cases in Europe, and the market continued to rally like nothing happened, climbing the wall of worry. And what do you do when you climb the wall of worry? You create air pockets. When reality hits, those air pockets are hit and you see significant flush down in the market. Here we go again, climbing the wall of worry, assuming that there is a stimulus deal, even if there is no stimulus forever. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.